This week it's the turn of Nike, who gave us a trading update for the latest quarter, and it's fair to say that shareholders weren't that pleased with the results. And if you tune into my content regularly, one of the main reasons for the disappointment won't come as too much of a surprise. Before I go into the details, please make sure that you are subscribed to Full Frame Kicks on YouTube with the notifications switched on so that you get all the latest content as and when it drops. And you're also following myself, the Sneakonomist, Andy Wilson, on Instagram, as well as at Full Frame Kicks as well. So onto those Nike earnings. So they gave us their latest quarterly update. The revenues, or the sales, came in at a whopping $10.4 billion. Yes, that's just for one quarter in a year, over $10 billion of sales. Now, believe it or not, that was actually a little bit light versus what people were expecting. When we just scratch the surface a bit, we'd start to see some positives and some negatives. So, direct to consumer, DTC, something we've talked so much about and is so integral for these businesses, especially in the last year. DTC sales rose 15%. Digital rose 60%. Now remember, a lot of these sales at the moment are being forced through digital because stores have been closed or remain closed. So if the overall number was disappointing and those two elements were actually quite good, it's the wholesale side of the business that was disappointing, and there is a good reason as to why, which I'll come to in a second. I'm just going to look at the regions now. Greater China, which is one of the biggest growth areas for these manufacturers, their sales came in up 51% for the quarter, so a very strong showing there. You'll remember that this time for the quarter, this time last year, they were fully in lockdown over in China, so that's why those numbers do look particularly strong, but it's still a very, very good showing. For North America, they were down 11%. The main reason here is there was a global container shortage and port congestion. For EMEA, sales fell 9%, and that's because of store closures still. So 45% of Nike stores were closed for the last 2 months of that quarter. So going to that global container shortage, it's what we've talked about previously. And if you go back to some of my content, you'll see on there that I talk about it more in depth. But the huge demand for products that are coming out of China and Asia, etc., being shipped over to the US particularly, is causing a huge shortage of these containers that are loaded on the boats. And also the ports are still not running full steam. You've got people self-isolating through illness, so you've got drivers that might not be there, you've got port staff that might not be there. There are a multitude of different reasons as to why. So a lot of these boats might be actually sat waiting to get there to actually to dock and to have their products taken off. But then it's a race because they literally just want to get those containers empty back to China as quickly as possible to be able to then fill them up and bring more products over. So that port congestion and that container shortage led to a 3-week delay for wholesale. Now, if we look at another important factor, which is gross margins and inventories, we've talked previously about how important it is to make sure you've got enough product. If you've got too much product, you have to end up cutting the prices. Remember, if it's evergreen stuff, as Adidas call it particularly, stuff that won't go out of fashion, you can put that away for the right season and bring it back out again and sell it. But if you've got an abundance of stock that you haven't sold and it might go out of fashion, you have to cut the prices. Again, this goes back to one of the reasons why these brands want to do more DTC, because they keep more control over the stock. They're not sending it out to wholesalers and then getting it sent back when they haven't sold it. So gross margins were up 130 basis points. It's 1.3%, and that's due to a higher amount of full priced products. If you've got too much stock, as I say, you have to cut the price. If you have not got enough, the stuff you've sold would have been sold for a high price, but you're missing out on sales. So what you want to do is have just the right amount of stock, and then you can sell stuff without having to discount it, but you can fulfill pretty much all of the sales that people want to be purchasing. So onto those inventories. Inventories were up 15% year on year. It doesn't seem like a massive increase, and you may think, well, hold on, inventories are up and gross margins are up. Well, that's kind of good. The problem here is that inventory number, a lot of that stuff was sat on boats waiting to be unloaded. So it's almost like the worst situation at all. It's not like it's in the shop and people don't want it, or it's not like it was on the store shelves, you've sold out and you haven't. It's on a boat. You can't sell it from there. So that's why we saw gross margins higher, because this stuff wasn't in the shops. So there was a shortage in the shops, but inventories were up because this stuff was stuck on boats. Now the shares fell, they've been down around about 4 to 5% on the day straight after the earnings. A lot of people are looking through these hiccups, and I'll tell you for why. Because I know there's been some slight delays, but we are getting towards the time when things are going to start to reopen again. But the anomaly that has been this shortage, if you like, of containers, that is something that is going to be not quite a one-off, but it's something that will sort itself out over a period of months, etc., as things start to get back to normal. The products were there, but they were stuck on the boat. So investors will look at that. Okay, they'll punish the shares initially, but they'll start to look through that and go, okay, if we didn't have that port shortage, the container shortage, if the ports were running okay, then actually Nike's setup has been very, very good. Remember that DTC was up 15%, digital was up 60%. So they're ticking a lot of the boxes, but it's so key that you've got the products on the shelves or in the warehouses to serve online when people want to buy it. And that was a classic example of what happened and why there was some disappointment. If you've got any questions, please do give me a shout. Either DM me on Instagram, or you can always put the comments below this video. Thanks as always for watching, and I'll see you soon.